Let's discuss some more actually global cues aside of crude with Arnab Das, who is a global market strategist at Invesco. Hi Arnab, good afternoon to you from India, and thanks a lot for joining us today on Bloomberg Quinn. Well, crude's been hogging the limelight since morning here, and considering how important the prices of crude is for India, considering we import 80% of our requirement. But there's lots more that's lined up, Arnab, for the week. We've got the FOMC meet where the economists are expecting a 25 bips cut. A lot of cues coming in with regard to the US-China trade war. Let's see what happens come 1st October when the negotiations take place once again. So what's your prognosis, what's your assessment to what's happening with the world right now, especially with regard to global equities?
I think that, we've had the global economy and the global financial markets buffeted by a number of shocks and quite a lot of uncertainty. And in the last week or so, there have been some efforts to address, or at least in the short term, improve some of these uncertainties. And it seems to be a bit of a rapprochement developing between the US and China, not to escalate further, maybe come back to the table with, let's call it more concessions on both sides, maybe so a bit more of a reprieve kind of environment. That should help alleviate some of the uncertainties in the short term, maybe not in the long term, but in the short term. So that should be positive, and I think it's already being reflected in a bit of a recovery in risky assets, including equities, and a bit of a sell-off in government bonds. Of course, all prior to the oil shock that is just taking place now. I think if we step back, right, what's really going on here is that there's a lot of uncertainty that is affecting trade, that is affecting investment, and that's affecting the manufacturing sector in the global economy. The consumption and services sectors in most places still seem to be holding up relatively well, although there are some spillovers. So the impact of all of these things is decidedly a drag on global growth, and that's why we're seeing many of the major central banks shifting from normalization towards more easing. And, I think we will see more of that continue over time, and possibly fiscal policy will eventually come into play as well.
Arnab, so in light of this easing of policy, which we've seen from most of the banks worldwide this year, we've not seen much of a risk on trade, especially the sort of uncertainty that you highlighted, which we've seen for global equities in the last 2 to 3 months. As a result of that, there's been more money which has been flowing into safe haven assets like gold. So do you feel for the remainder of this calendar year, this uncertainty will continue and the trade on the equity side will be risk off?
I wouldn't be so sure that it'll be completely, one-sided and be risk off. I think our view would be that it makes more sense to be somewhat diversified rather than heavily concentrated in, so-called safe haven assets like bonds or gold. The valuations of bonds is already very rich. Which speaks to a lot of this uncertainty, being at least significantly priced in, maybe not fully priced in if there are more bouts of uncertainty. There's obviously a meaningful risk of a significant slowdown or even recession in the U.S. Or global economy. But that's not our central expectation. Our central expectation is that the stimulus is coming through, will help cushion the downside. There probably won't be a significant synchronized rebound in the global economy like in 2017. So on the other side, it probably doesn't make sense to be heavily invested in, overinvested, let's say, very heavily overweight in equities or emerging markets or corporate bonds, especially high yield bonds, because the growth rebound is unlikely to be strong, unlikely to be synchronized like in 2017. But the stimulus should help cushion the downside. So the most sensible thing to me seems to be, to be diversified rather than too heavily risk off or too heavily risk on.
Sorry, Arnab, if diversification is the call, will India as a country will feature in the diversification list? Because we've been underperforming at least for the last 2 months. Foreign investors have been selling in the last 2 to 2.5 months. And one were to look at the economy, the GDP growth is also not looking great. We're at almost 25 quarter low. So in the EM basket, where does India stand right now?
Well, I think if you look across emerging markets, you have a number of countries, including India, where the so-called idiosyncratic or country-specific stories do not seem to be that great. And indeed, the shine has come off India quite a bit in the last few months, with the economy slowing down significantly, with a bit of a concern in the international marketplace that the Modi government, after the landslide victory, is focusing on nationalism rather than on reforming the economy. I think to have a change in sentiment and a change in the flows vis-a-vis India in particular, we'll need to see the government continue to take more measures that help to support the economy, both cyclically, short-term, and more importantly, structurally, long-term. Right, the Modi government needs to go back, I would suggest, to its roots of pursuing much more significant, big-ticket, reforms in the economy. Labor reform, land acquisition, these kinds of things. They can be promoted to some extent through competition between the states, but I would suggest that if the federal government takes the lead and shifts the focus in the marketplace from these movements that are seen as, somewhat nationalist or somewhat geopolitically risky, towards measures that are clearly oriented towards restoring growth momentum, which has slowed significantly, then the India story will become very attractive in a world that is starved for growth and reform.
Right. Arnab, good afternoon. And one last question would be with regards to where does the India story stack up in terms of an equity market investment within the EM basket? I mean, there are better options. Consensus is tilted toward, a country like Japan, China too, now that they have opened up the market. There's no limit to investing in equities. That too could likely see a flush of inflow. Where does that leave India then in terms of the pecking order?
I think that is a factor that is taking place, and India is being affected. Not just India, other major emerging markets being affected by the index inclusion and the liberalization in China. There's a bit of a flow out of other markets, including India, into China, both in equities and in bonds, because the bond market is also being opened up in China, much more so than in the case of India. I think we should see that as more of an adjustment, a one-time rebalancing in globally benchmarked portfolios, which has to take place. And once that is done, the focus will turn back to the traditional issues of growth and inflation around the world and in the major economies, including India, and what's being done on the reform front. So I would, pay attention in the short term to this index issue and the rebalancing associated with it. But really, I would keep my eye on the ball here, which is about growth and inflation cyclically and about reform to generate growth domestically in a world that is much more challenging than when the Modi government took office originally in 2014. Right? It's a much more challenging environment. So all the hype associated with Make in India, with the need to generate 1 million jobs a month, it's no longer about slogans. It's about getting real here.
Waiting for things to shape up on ground as well. Arnab, thanks very much for joining us. Really appreciate you taking out the time.